Welcome everyone to the July edition of the Shaw & Partners monthly video update. Now we have officially passed through the midpoint of the year. It's been a pretty rewarding 6 months for investors despite the geopolitical ructions, and it was certainly quite a strange quarter though as markets pushed higher despite the uncertainties associated with the Middle East conflict. So how have markets fared over the month? Well, monthly returns for share markets, they were mixed but generally resilient, with evidence of a rotation away from the narrow AI or chip-related winners and into a broader cross-section of sectors. The global index, the MSCI index, fell slightly, 0.1%, but within that though, the US stocks, as measured by the S&P 500, fell 1%. You do need to consider context though. If I look at that index over the last 2 months, it had actually gained 15%, so it really only gave back a small part of that move. European markets were generally positive, and the top 50 European companies gained 4.7% in local currency returns, so that's a solid result. One of the other features of June though was a weaker New Zealand dollar. That significantly lifted our returns when stated in our local currency. The Kiwi fell 3% against the euro, but over 5% against the US dollar. Now, look, that boosts returns for exporters, and it makes New Zealand look like a very attractive holiday destination for travellers, but not so appealing for Kiwis heading away for an overseas trip. And the recent strong rally in emerging markets took a bit of a breather, and we saw evidence of the rotation I referred to earlier in the almost 9% fall in an index of the Magnificent Seven stocks, with investors sort of favouring financials, industrials, utilities and healthcare stocks. What was notable over June though was that the New Zealand share market, measured by the NZX 50 index, outperformed the Australian market, our local market gaining 2.9%, versus a 0.6% rise in the ASX S&P 200. A good win for the NZX there. A key development over the month was the signing of the Memorandum of Understanding between the United States and Iran. Now, using the Brent crude price as a measure, there has been a big drop in the price of oil in the spot market. So it closed the month at $72.92 a barrel, a very long way from the peaks seen in the early stages of the conflict when it was close to $120 a barrel. But there's still some risk over that outcome. And if I look at interest rates over the month, US 10-year Treasury bonds, so US interest rates, they traded a fairly narrow range, but New Zealand interest rates did generally just move a little bit lower. And there does seem to be some speculation that the domestic inflation rate won't spike quite as high as was previously expected. And last month we saw the monthly inflation figures released by Stats New Zealand suggesting there was a bit of heat coming out of the inflation pressures here in New Zealand. As ever, we continue to manage investment portfolios with a longer term view. Look, we note these short-term movements, but we keep our focus on achieving consistent returns over the medium to long term. Now, there's some debate over whether the bank will continue to hold or get on with normalising the official cash rate. Our view is that the OCR will move higher before the end of the year, simply to move the rate away from what is now a stimulatory level and closer to a more neutral rate. But given the recent fall in the oil price and the implications of that for inflation, the timing and potential expected peak in the OCR are now being re-examined. While domestic growth is expected to slow down in the second quarter, both the central bank and New Zealand Treasury do expect inflation to fall quite quickly and growth to rebound. And it's still our view that things like consumer confidence could recover quite quickly if the price of petrol at the pump falls materially. Now look, we aren't making any changes or significant changes to our current strategic asset allocation position. Look, we're mindful of the mix of our global fund managers, and we're really staying attentive to potential areas of overvaluation. One aspect we are focusing on at the moment is the potential broadening of performance away from the narrowly focused performance gains we've seen so far over 2026 and the rotation that we saw in June, being an example of how that may play out. Having a diversified portfolio is our preferred position, with attentive monitoring and continual oversight. And now, more so than ever, we think having a more active approach to portfolio construction is prudent, with markets having become more concentrated. Having access to our professional advice and experience makes navigating the investment journey more dependable and has been proven to improve the outcome. That guidance and advice improves the potential for successful navigation of financial markets, always taking into account your long-term investment objectives and risk tolerances. What we want to do is give you peace of mind about achieving your goals. So if you need help or guidance, why don't you get in touch with us, and we'll bring our decades of experience to assist you in providing for your financial future. But look, if you want to know a little more, you can look us up at shoreandpartners.co.nz or on Facebook and LinkedIn. We would love to hear from you.